I think that's a bit of a wild card with Trump in office south of the border. There's a lot of things that he could do or say that might disrupt that. But, I think the consensus is interest rates are going to move up a little bit, but not that much. So as long as that stays in a reasonable band, I think real estate will fare fine and won't have to deal with that element for the next couple of years anyway.
Interestingly, in the course of last quarter, the fourth quarter of 2016, we saw a spike in long-term rates here in Canada. We haven't necessarily seen that translate into a systemic rise in overall rates. In fact, short-term rates remain historically low. In direct answer to your question, because I'm kind of going roundabout, is that, as I mentioned in my first question, there's a lot of capital out there, both debt and equity. And as a result, that is going to have a natural effect on its cost because it's plentiful. So therefore, overall, yields will probably remain fairly compressed. Two, given the kind of quantitative easing that's occurred here in Canada, much like what happened in the States. There's plentiful supplies of capital, and that's really kind of the issue for us, is how to deploy it effectively.
We expect interest rates to stay relatively low in Canada. It's very much like the equity side of the equation. So it is very, very competitive to compete for acquisitions. Similarly, on the debt side, it's just as competitive. So there are just as many lenders out there as there are buyers, and they're all looking to deploy their capital. So given that, we expect that there'll be lots of capital available at quite good rates, but in particular, it will be available for the best properties and the best sponsors. When the quality of the asset or the risk goes up or the quality of the sponsor goes down, we expect pricing to widen just a little bit and it to be a little bit more difficult for those individuals to get debt, or at least a little bit more expensive.
Well, that's going to be one of the big questions. So we've seen the bond market twice now. 2013, we had that what we call tapering tantrum, where the bond market ran, came back down. We saw repricing come off. There was a lot of impacts. We've seen it happen again recently, where the bond market's gone up. It's now settling back down in the U.S. and the Canadian markets. So it's something where we think there's growth in the system. We think that the industry and just the world is just poised for a little bit better growth. So we will see some increases, in sort of the capital markets, debt in particular. But I don't think it's going to be that dramatic. I would say that by the end of the year, it's probably up another 10 to 25 basis points, and that's going to be it.